Let's talk about shareholders in a complete liquidation of a corporation. Things are going down, likely through bankruptcy, because corporations generally don't like to say, oh, I think we run our course, let's close down shop, which is a whole interesting concept. I think there's a lot of companies that probably should have shut down at a certain point, but no one wants to make the call to do that. When a corporation goes through a complete liquidation, it essentially dissolves, sells its assets, and distributes the proceeds to its shareholders. The shareholder, in turn, must treat the property or cash received as full payment for their stock. This transaction has tax implications for the shareholders, as they must recognize a capital gain or loss on the transaction. Think of it like this is your return on investment. This is your capital gain or loss. It's kind of like you're being forced to sell your stock, and whatever you get from the corporation in this case is what the selling price would have been. So instead of buying stock at $200 and selling it for $300, maybe you bought stock at $200 and in liquidation you get $300 of value of cash and property or whatever. So same sort of situation. Nothing really changes there. The capital gain or loss is determined by comparing the fair market value of the property received with the shareholder's basis in the stock surrendered. The basis is generally the original cost of the stock, plus or minus adjustments for events like stock splits or dividends. Oh, got to always keep those into account. We've got a calculation here. Well, like we said, it's the fair market value of the property received minus the basis of the stock surrendered. Now, if the fair market value of the property received is higher than the basis of the stock, which we hope it is, hopefully we have a gain, we'll have a capital gain. Conversely, if the fair market value is lower than the basis, the shareholder will have a capital loss. This is your return on your investment. This is what you're getting back. So for example, let's say that Jane, who's a shareholder of ABC Corp., which has decided to liquidate its assets. She originally purchased 100 shares of the corporation stock at $50 per share, giving her a basis of $5,000. That's 100 shares times $50 per share. Now, upon liquidation, Jane receives cash and property worth a combined total of $7,000. So, at least Jane's having a little bit of a gain. She's getting $7,000 of value. She bought into this for $5,000, so she's coming out on top. This is considered the fair market value of the property received. To calculate the capital gain, we're going to subtract the basis of the stock from the fair market value of the property received. So that's the $7,000 minus $5,000 gives us $2,000. That's your return on your investment. In this example, Jane would recognize a capital gain of $2,000 on her income tax return. This gain would be subject to the appropriate capital gains tax rate. Make sure you are familiar with those based on our individual lessons, based on the holding period of the stock and Jane's individual tax situation. All right, another good one down. Now we're dealing with our 80% owned subsidiary, possible related party situation going on. In a tax-free liquidation of an 80% or more owned subsidiary, the parent corporation receives the assets of the subsidiary without any immediate tax consequences. It's kind of like, hey, we know this is essentially us. This is a fully owned subsidiary. It's essentially the same company. So it's really just kind of giving the assets back to the parent company. This is because the liquidation, it's going to be treated as a tax-free reorganization under Section 332. You don't need to know the section. Just like to keep those in there. If any of you are extra particularly interested in the IRC. The parent corporation will take a carryover basis in the assets it receives from the subsidiary, meaning the basis of the assets remains the same as if they were in the hands of the subsidiary, kind of like a deferred gain or loss, just carryover basis. Carryover basis is important. It's going to determine the amount of gain or loss recognized when the parent corporation eventually sells or disposes of the received assets. Think about this like like-kind exchanges. Again, you're just having a deferred gain or loss here. In general, the basis of an asset is its cost or original value, which may be adjusted over time for events like depreciation or improvements. And that's something we've seen in our cost recovery lesson. I always like tying all our lessons together. If you have any questions, you go to those ones, check them out. For example here, let's assume that parent corp owns 100% of subsidiary corp. Subsidiary has two assets, asset A with a basis of 10 and asset B with a basis of 20. Now in a tax-free liquidation, subsidiary corp transfers both assets to parent corp. Since the transaction qualifies as tax-free because of our 80% rule, parent corp takes a carryover basis in the assets it receives from subsidiary corp. Nothing too crazy here, and none of these rules ever are too crazy. It's just remembering all of them in conjunction with every other rule you have to know for this exam. Thus, parent corp's basis in asset A, it's going to be the same, 10,000. Parent corp's basis in asset B, it's going to be the same, which is 20,000. Now, later on, if parent corp sells asset A for 15,000, the taxable gain would be calculated just simply as the selling price minus the carryover basis. So in this example, parent corp would recognize a taxable gain of 5,000 on the sale of asset A. The gain would be subject to the appropriate tax rate depending on the nature of the asset and the holding period. Generally, corporations can have that flat tax rate, so we're not going to deal with the same as individuals. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.